Hello, everybody, and welcome to another episode of Cycles TV. And I am very excited today to have with us Tom Basso. Welcome, Tom.
Good to be here, Richard.
And this is a little different than what you might normally encounter on Cycles TV because we're not going to be talking about cycles hardly at all today. What we're going to be talking about instead is, let's call it the second most important thing in trading, except for cycles. And that is position sizing, AKA risk management. And Tom, you've been at this for quite a while. You were profiled in Jack Schwager's New Market Wizards and coined as Mr. Serenity.
Yeah.
Which a title I love.
A name that will live in infamy.
And I suspect that
decades.
Serenity is connected to your love of position sizing.
Yeah, it's partially that, and it's a lot of mental stuff too. But if you set yourself up for making your ride very difficult, it doesn't help your trading psyche any. You're having to be exceptional at trying to manage yourself. So I try to start with, how am I going to buy and sell? How am I going to position size? And then it makes the mental side a little easier.
So can you just tell us a little bit about your background at this point and your journey to where you are today?
I started out investing as a paper boy at 12 years old. My father had a mutual fund salesman from Fidelity show up at the house, and I listened to the pitch. He didn't buy, and I did. And it was a load fund, didn't even get back to break even until I got out of college at 22. So I learned a lot about costs of trading and markets going up and down at an early age. And when I came out of college, I was a chemical engineer from Clarkson University up in Northern New York. So you got a lot of computer background, math background. I was familiar and comfortable with numbers and, writing some code. Wouldn't call myself a computer programmer, but I'm not intimidated by it. And I started the process looking at all the different chemical companies out there that might offer me a job. I thought maybe if I saw a chemical company doing well with their stock, maybe that would be a sign I should go try to work for them. So one thing led to another. I ended up in St. Louis, and at lunch we would end up talking about stocks, just a bunch of young kids making more money than they ever dreamed possible, probably. And the discussion would always be on investments at the lunch hour. And we started an investment club. I ended up de facto managing it. That turned into an investment advisory business. From there, it ended up, I added futures because I was trading futures personally. So now I put that into the mix and became registered investment advisor, registered commodity trading advisor, left the original firm and ended up forming Trendstat Capital, moved it to Scottsdale, and now happily retired 18 years. That's as fast as I can get through my life.
That's a quite a succinct story of something that I know has had many twists and turns along the way.
A ton.
And you were, you were in some positions of authority within the futures world, weren't you? Like on regulatory boards or advisory boards?
The National Futures Association is an interesting operation because it's a self-regulatory body where traders that do trades in the futures industry, for instance, take a small slice of each trade, the commissions, and it flows to the National Futures Association to regulate the futures industry. They have about, last I knew, it seemed like 35 or 40 people on the board. It's a very large board. And just from the commodity trading advisory side of the business, there's nominated and elected 3 representatives to represent the commodity trading advisors. There's also representatives for the futures commission merchants, for the pool operators, for the government, for the, there's all the different stakeholders in the futures industry are represented by a group of people. So I was one of 3 people that represented the commodity trading advisors, and I was on that position for a good number of years before I retired.
And so today you're retired, living in Scottsdale
Scottsdale, Arizona.
in the mountains.
Uh, I move up to the mountains on May 5th this year
All right.
for the summer, and that's 90 minutes away up at 5,000 feet. And it looks like Colorado. People wouldn't even, if I
Beautiful.
showed you a picture of my backyard up in Payson, Arizona, you would think I'm in, I don't know, someplace in southwest Colorado.
Nice. And then you're educating in your retirement.
Yeah, I'm having fun. It started out kind of innocuous. It started out with, there's people finding out I have the same email address I've had for the last 30 years, probably. So people would just take a shot and send me an email and ask a question. And I was answering 6 or 7 of these a day. And I thought, this is kind of unproductive. And I'm answering it the same way, the same question, same way. And my wife and I were talking one time, sipping wine by a pool on a Sunday afternoon in Malaga, Spain, of all places, and under a beautiful sky, a block from the Mediterranean Sea. And we were talking about this issue of having so many emails coming in. I was trying to figure out how I might automate it or do something to just reduce my time and make it more efficient to help people. And we came up with a website. And prior to that, I had used the term enjoy the ride at the end of a lot of tweets or Facebook messages that I would send out.
Mm-hmm.
So she immediately said, yeah, you could call it enjoytheride.com. Well, it turns out that was taken,
Mm-hmm.
but enjoytheride.world on the screen behind me was not taken. So I thought, well, people are sending me emails from all around the world. I might as well call the thing enjoytheride.world. So we created a website. It took me about a year, and I learned a lot doing that. I'd never created a website before. The Trendstat Capital website that we had was created by full-time computer professionals that I hired.
Mm-hmm.
And so I oversaw the operation, and I got to say, I don't like that color and change it to that or whatever, but I didn't get into the bowels of creating the thing. So now I got a chance to learn how to actually do a website. So that was kind of fun and learned a lot there. And then we went live, and it's highly successful. I get thousands of visitors a month. Wrote a book for it on position sizing that we're going to talk about, I suppose.
Yep.
And there's a lot of other useful things for traders there. Some of it's free. There's lots of interviews that I've done over the years, videos.
Fantastic.
Books,
Great resource. Encourage everybody to check it out. Enjoytheride.world. So let's get into it, Tom, because I do want to pack a lot in today, and I want to get into nuts and bolts and make sure that our viewers come away with something very concrete and substantial that can help them, as soon as they're off this call. So before we get into position sizing in particular, I think your broader philosophy is that successful trading kind of has 3 parts to it. So would you just give us an overview of successful trading to get us going?
In my mind, I rate the order as the least most important to me as a trader is where I buy and sell. So where exactly is the price level that I need to buy or sell? And the reason I say that is I'm more of a trend follower. And if I get in on any trend and it's going to run for months, whether I get in today or tomorrow, not that big of a deal. Obviously it'd be great to get in as quick on a big trend like that as you possibly could, but it's not going to kill you.
Yep.
The second up.
So meanwhile, I just want to stop there for a minute, because that's very significant that to you, the least important thing is where to buy and where to sell. But I would venture that for most people, they think that's the most important thing, right? But it's the least important thing. And I agree with you completely. And it's one of the things that frustrates me to no end, in this world of especially retail finance, that all of the attention is put on when to buy and when to sell. And I totally agree with you. It's the least important thing that you need to be successful. So
it's where I started as a trader, worrying about things.
Yep.
It's where everybody seems to start. If you look at most trader platforms, at brokerage firms and whatever, they're all on buy
Filled
sell
with that.
indicators.
Yep.
They're not
Filled
on
with it.
position sizing. They don't even talk about it in most cases.
Exactly.
The
So
second most
number
important in my
two.
mind is position sizing, which is what we're talking about today. And the reason is if you can imagine, or I go back to Larry Hite at Mint, who was a very successful, famous market
Yeah.
wizard in the first Market Wizards book.
Mm-hmm.
He talked about making your bet sizes the same. And the reason is you get predictability, you get each bet or investment having an equal impact to your portfolio. If you bet sort of twice as much this time and half as much the next time, well, then obviously this time investment's going to have a lot more impact on your future success or failure. You could wipe yourself out if you invest too much. So investing in optimum for you becomes very important. The other factor,
And you didn't say equal dollar amount on each bet. You said
I did
equal,
not.
What did
I
you
said
say?
equal risk
Equal risk
to your portfolio.
Yes.
And
Yep.
that's what Larry used, that same term. And that
I
got me
actually wrote
thinking
down a
about,
quote from Larry that was in your book. Aim for the best growth rate consistent with extremely rigorous risk control.
Mhm. That's the way I approach life in the trading world. The third thing, and the late great Dr. Tharp, who was an investment
May he
clinical
rest in peace.
psychologist,
I mean, he passed away just in the last few months.
just a few weeks ago, actually.
Yeah, I
And
had talked to him a few months ago.
yeah, he
And,
was a great guy that helped me crystallize some thinking early on. I helped crystallize some of his thinking early on, I think,
mhm.
at the same time. And what he would say, and I agree with him after we had this little discussion along the way, is that the mental side is the most important. Why? Because you as a human being can step in and screw the whole thing up. I don't care how well your buy sell decisions are. I don't care how well you position size. If you decide to sleep in today and not even be on the job or doing what you're supposed to be doing, it all falls apart, right? So it's the mental discipline, it's the awareness that you're deviating from your plan, it's the self-confidence to have the market hand you 3-4 losses in a row and just bounce back and keep doing it.
One of our mutual
All mental.
friends, Mr. Brad Rotter, who actually introduced us, he was one of the pioneers in the hedge fund industry. He got a lot of hedge fund managers started.
Yeah.
And one of his rules was, if you're going through a divorce, you can't
Stop
manage
trading.
my money.
Yeah.
Right. And that's life, right? Life throws stuff at us, and it doesn't matter how good your buy and sells are or your position sizing. If you're in the wrong place mentally, you're toast.
Well, and I even get people saying, well, Tom, you're known as an automated trader. How you don't have to worry about your mental side.
Right.
Well,
Okay.
I have the ability to not run the program. I have the ability to pull the plug. The computer doesn't work anymore.
Yeah.
I'm still the ultimate decision maker that's got to keep going. I'm suffering several losses, and I could easily say this black box that I've got created is not working anymore.
I don't want to go down a philosophical rabbit hole here, but to me, this is just so foundational that we have to realize, that we're the ones making the decision, right? And there's all this focus on tools and on numbers and on indicators and measurements. And they all seem like they're out there. The markets seem like they're out there, right? You're looking at the screen, it's sort of outside of you, flashing lights, but ultimately the most important part is in here.
Exactly.
All
so
right.
True.
Thank you. So since we're here to talk about position sizing, let's do it.
All right. Well, why do it and how you might do it? What happens when you're trading, at least in my world, I don't know about yours, but all positions have various types of risk. You got the risk of the stop loss. You got the risk of it moving quicker or slower, which can get into your head. I mean, obviously, if something doubles tomorrow, it kind of grabs you. If it cuts in half
Right.
and goes down by 50% on open, it also will grab your attention.
Right. And
There's-
that's one point I just want to draw attention to, because earlier you said, the mental side was the most important, position sizing second most important, but I found position sizing has a big effect on my mental state.
Sure, it does. Yeah. Managing risk. And there's positive risk and negative. Managing risk in general is sort of what a manager does. It's one thing to put a stock position on, let's say, and then just walk away from it for 6 months. But it's another
Right.
one to every day take a look at it and say, is this still the right position for me? And do I have the right size in the position that I'm supposed to have? Those
As
are
speculators, we are risk managers, right? That's what we get paid for.
exactly.
With
Yeah.
the opportunity wouldn't exist if it wasn't for the fact that companies, institutions need to mitigate risk, right? So they're in capital markets.
Correct.
And so our job, literally what we get paid for, is to manage, to take that risk off their hands, right?
Correct. Exactly
And
right.
to
And we get the
manage it,
excess, we get paid for that.
to budget risk and spend risk to maximize reward.
Exactly. So you got risk of bankruptcy, you got risk of news coming out and doing stuff, you've got risk of the market. So on a position basis, you can do something with the first two fairly easily. Unless you
So
have a
the
crystal
risks
ball, I'm
to
not
your
sure
stop
about the
loss,
others. What's that?
the risk to your stop loss being number one. We'll get into what that means. And then the risk of volatility, the position sort of accelerating or decelerating
Correct.
in either direction.
So let's give you a simple example of how you could manage risk. So in my mind, if a trader goes into a position and doesn't know where he's getting out with a loss and where he's trying to get out at a profit or having a plan for getting out of a profit,
Mhm.
he's setting himself up for failure. So let's assume that everybody is sensible enough to, in the first important thing in trading, to decide where you're going to buy and to set some point that's a stop loss.
Where you'll get out of the trade.
Yeah, period. I'm wrong. For whatever reason, I'm wrong. It's the trade's not working out. I'm going to cut my losses short.
Okay.
So in that situation, you can calculate a dollar risk or a point risk if buying a stock or something.
Mhm.
For one share of stock, you are taking X dollars of risk. That's the point where it is you're getting in to where you would get out and stop out of the trade.
All right.
So that's pretty simple. The formula down there, you learned that math, I think, in probably before 7th grade, probably, or so.
Yep.
Here's
So
an
here's an
example.
example.
$100,000. I'm kind of keeping the numbers easy here.
Yep.
1% risk allocation to a single position. If you
So
make
you're
that
gonna
number
risk
larger,
$1,000.
yeah, it's so you're risking down at the bottom here, position size by risk. You take your 100,000, you multiply times 1%, and you get $1,000.
Yep.
We know that the price up above here to buy a stock at XYZ is $20.50. And let's say the stop loss happens to be $19.05. So I know that I've got a risk of $1.45.
Mm-hmm.
Well, if I take 1,000 shares and each share I have,
$1,000, you take $1,000.
yeah, 100,000 times 1% is $1,000.
Yep.
And each share that I would buy is $1.45. It allows me to buy 689.66 shares.
Right. That's,
of course, you don't want to buy 0.66 shares, although you could, I suppose, these days. That wasn't even available to the world when I actually wrote this slide up.
Yep.
But
so you're actually, the stock doesn't cost $1.45. You're taking $1.45 of risk per unit of stock.
Correct.
So you buy 689 shares.
Right.
And if those 689 shares fall out of bed straight down, by $1.45, you're out.
Gone.
And you lost 1% of your portfolio, or $1,000.
Correct. Absolutely perfect.
Pretty simple.
Pretty simple.
But yet, widely ignored.
Widely not done. Exactly.
Widely not done. But I mean, to me, this is the most basic thing that anyone can do, that if they're not doing it, this will improve their performance.
Yeah, it's
dramatically.
almost like a free thing the market gives you. There's very
Yes.
few, I don't know what I call free things you can kind of do to improve your
Yeah.
results. But if you want a better return to risk ratio, it's clear to me in all the research I've done that doing things like this help you get a better return to risk ratio. And a better return to risk ratio makes your mental side easier. It doesn't necessarily make you more money, but it allows you to stick into the game, to keep playing the game,
Yeah.
to keep trying to produce those returns and not get knocked out to the point where you can't come back.
The way I see it, Tom, it's kind of like we have Bollinger Bands on our psychology, you know?
Okay.
And what
That's a good way
happens
to put
is,
it.
like, when a trade gets outside of those bands, right?
It starts getting into your brain.
Shit happens.
Yeah, exactly. And you'd rather not have that happen. If you
Rather
want to
not
be
have that
Mr.
happen.
Serenity, you for sure don't want it to happen. You have a
Right? You want your
reputation to.
marriage to survive, and you want to have time for your family.
Yeah, exactly. There's other things in life
So,
besides trading,
all
although
right, so you
some
got to make,
traders don't think that either. They
yeah,
24 hours a day, they're on
right.
it.
God bless them.
So here's an example. I don't know if your viewers get into futures at all, but here,
Absolutely, the foundation is very. A lot of people interested in the foundation are, a lot of them are in agriculture, interested in commodities, right?
there you
So
go.
futures are definitely a part.
Well, I
of-
picked gold because
Yeah.
the math is easy.
Great.
You get into some contracts like, soybean oil or something, you get
Everybody loves gold. Let's go.
well, gold's simple because it's 100 ounces. So everything is pretty easy to calculate, but 100,000 again, let's say it's 1% to our position in risk. And let's say gold futures is 1275 with a stop loss at 1267.50. I've got $7.50 per contract times $100 because it's 100 ounces of gold per contract. So 1 point move in gold is going to be $750. So now if I know I've got 100,000 down here at the bottom, times 1%, it's the same 1,000 that we're risking on the trade. And I know that one contract of gold, which as low as I can go, would be $750. That would be 1.33 contracts of gold, or rounded down, one contract. Pretty simple.
Again, pretty simple. Do you
I
have a
would take an
gauge?
aside. I would take an aside here and point out that I actually trade the micro golds, which is 1/10, I think, the size
Okay.
of the contract that I used here. So
Okay.
that's an option for smaller traders that might be listening. Check out the micro gold contracts because they're going to track with gold, almost exactly. And yet you might be able to buy 3 or 4 contracts of micro gold for your portfolio instead of barely being able to afford one of the large contracts. So it's a highly useful tool, and it helps you manage your risk and fine tune it to even a finer degree. So I'd encourage checking out the micro contracts.
Okay, thank you.
Volatility is another thing. As we pointed out, we have the Bollinger Band on our mental processes, and we want to keep everything serene because we want to be Mr. Serenity. Well, you look at the morning news. I watch Stuart Varney when I wake up in the morning here, and he puts up the top 10 movers up, the top 10 movers down, the top 5 movers in the Dow, and good grief. And some of these things are moving just on the open.
Definitely isn't trying to, keep you serene.
Yeah, 5-7%. I mean, people used to accuse me of trading commodities, and the next word out of their mouth would be, are you crazy? Are you don't you know futures are risky?
Right.
And I look at the morning news, and the prices are up and down. Some of these stocks are moving 20% out of the gate. That's crazy. And average true range is what I use to measure volatility. There's a couple of other ways you could try to measure volatility, but average true range is nothing more than the average over a period of time of the normal 24-hour movement of whatever it is that you're tracking.
Yeah.
convert it into points or dollars or whatever you want to measure it as. And the reason I like it is it's so simple to calculate. You can use a spreadsheet easily. A lot of broker platforms will put it out on the screen for you. So to me, ATR is the way to go. And I usually use about 21 days. That's about a month of trading days. So that's a comfortable for my for my type of work. I use if I'm trading intraday, I'm probably into something like 20 periods of 5-minute bars, 24 periods, something like that.
Okay.
If I'm looking at a shorter term daily trading of say index funds or something, I might use 9-day or a 10-day, something like that. You can change that to suit your style. If you're a long-term investor, no reason not to use a 50-day ATR or something on that range.
So the basic idea of ATR, so, instead of just taking the high and the low of a day, you go back to the close from the day before, because oftentimes, that's
gaps.
There's gaps.
So
and so that gives you the range, the true range, right? For a 24-hour period.
Hours.
And then you take, the last 21 market days and take the average true range. And it just gives you an idea of what to expect in terms of the daily volatility.
Correct. And it's say the true range rather than the daily high-low close, because it takes into effect all those gaps that occur from time to time.
Right.
So the formula is right here.
Before we continue on, so your first approach to position sizing was to just use like a % of your portfolio that you're willing to risk on any given trade.
Correct.
So this is now a alternative approach of using the volatility to decide your position size, essentially. And I'm guessing that the more volatile, the smaller the position size, the less volatile, the bigger the position size.
Perfect. Because if you, for a simple example, let's say you have 10 things in your portfolio and one of them happens to move 6 times as fast as the other 9. Well, your portfolio is going to be dominated by whatever that fast moving guy does.
Exactly.
The rest are just going to be window dressing, and you're spending your time doing all that work for these other 9 things. And it's really the one thing that's driving your portfolio to a large extent. So you want to get a little more balance, not only in life, but in your portfolio.
And just so people know, like, we're not just trying to confuse them by introducing multiple approaches here. You do kind of tie these together in the end.
We'll get to that in a second.
All right.
But the formula for ATR, you can look up on investopedia.com, or you
it's everywhere.
Look at this presentation. It's right there.
Yep.
And you can do it on a spreadsheet if you want. So managing position volatility takes a similar approach to what we did over on the risk side. Let's say we have the 100,000, and let's say the risk allocation to a single position was 0.75. And the volatility of the stock, or how much it moved up and down, was 85 cents in a typical day. Well, then we take our 100,000 times 0.75, and that would give us $750 we would be able to spend in volatility. And we divide it by the amount of volatility that it has to get how many shares. It works out to 882 if we round it down.
All right, so you got $750, and you've got 85 cents of, per unit volatility on a given day, right?
On average.
On average volatility. So you can buy 882 shares of, which gives you 85 cents of daily volatility on each of those shares.
Perfect. So then we can also go over in the gold market and give a futures example. Similarly,
can we just go back to that for just a second, though?
Yeah.
So does that mean, like, So 85 cents, it looks like you have about, if they just went down by that level of volatility 8 days in a row, roughly, that would be your $750. Does that sound about right?
That would be in any one day.
Or is it, if
In
it's
any
down
one day,
85 cents on day one, then you're out of the trade?
you would, where your stop is a separate question.
Okay.
Where your position size is, if you buy this amount, on average, your portfolio is going to be pushed up or down by $750
In a day.
due to this position size
So your average kind of daily
movement.
push is $750, which is
Good or
probably
bad?
why you have a smaller, use 0.75% instead of 1% here. Back in the, the first approach, you had 1% of your portfolio that you were willing to risk, or $1,000, let's say.
Mhm.
In this case, you're willing to risk $750 a day
Of movement.
of movement, right?
You're saying that I can tolerate seeing my portfolio go up and down that much.
Exactly.
It has nothing whatsoever to do with where your stop
Where your
is.
stop is, right?
I'm just
Okay.
sizing the position so that I can see this type of movement every day. And if on the other side, on the risk side, I am saying that if this position just goes down for how many days it needs to go down to hit my
Yep.
stop, it could be
Yep.
5, 6, 7, 10 days,
Right.
whatever it is. Once I lock in that $1,000 loss, that's the most I want to take out of this.
Got
And in
it.
both of those levels, that should be trader centric, not
Mhm.
Tom Basso centric.
Yeah.
These are numbers that I'm just throwing out to make round numbers. If you want to make something more
No.
conservative, make those numbers smaller. If you want to be more aggressive, make them higher.
Beautiful.
Each person needs to decide for themselves. So in this futures example, using volatility, again, 100,000, again, 0.75, $750, then we're going to be able to tolerate in movement up and down. If we calculate gold futures, let's say the average true range over the last 21 days that gold's moving up and down about 3.6 dollars per contract. And if we multiply it times 100 again, that works out to $360 per day that the gold contract on average during this period in March is moving up and down. So we go through the same calculation down here at the bottom, 100,000 divided by times 0.75, that's $750. And we divide by 360, we get 2.08 contracts, and that would, of course, round down to 2 contracts. And once again, if you did the micro contracts, that might be 7 contracts or something like that.
Mm-hmm.
Something to continue. So
all right.
Again, this is different. So one is the loss of capital. The other one's the sustaining of having to put up with watching your portfolio go up and down fast.
Yeah, that's sort
Two
of those
different types
Bollinger
of-
bands of psychology, right?
Right. So which should you use, risk or
What you're doing,
volatility?
though, is you're basically letting each position have the same amount of volatility.
Correct. So
your net volatility is your position size times the volatility of the asset, right?
The portfolio is going to be the combination. I mean, if every position, say, went your way,
yeah,
and you had 10 positions and 0.75, you would have 7.5% positive day that day on an average volatility if you sized it by volatility.
Yep.
That's what it would mean. That would be moving pretty fast, but fortunately, the way portfolios work, you have diversification, you have non-correlation to some extent, especially if you're trading futures and you're trading, as I do. I think I got, what am I up to now? 31 different futures markets I trade now in my portfolio. So the odds of all of those going in my favor on any one day. I mean, if you look at any of my trading screens, there's green and red all over the place. They're not going to go the same way. So I'm willing to make the volatility a point where that one position does not sneak out and grab me and say, whoa, what the heck's happening with lumber today?
Right. Yep.
You
Which
know,
again can
what I'm
mess with your psychology, right?
exactly. So which should you use, risk or volatility? How about both? What I do is I always err to the conservative side of my position. So even though in some of these examples, you could have done more if you were using risk or volatility, I always round it down to the lower of the two calculations. So if we took the $100,000
Hmm.
and we went through that quick calculation and we came up with 689. And then when we did the volatility, if you remember, we came up with 882 shares.
Right.
I would look at the two and say, I'm going to do the 689.
Hmm.
In this case, my loss of capital is going to override my my ability to tolerate movement. Two different parts of my brain, and I'm going to make it easy on my brain to always be on the conservative side of it. By the same token,
Hence
we could go
Mr.
over.
Serenity.
Yeah. So so we had the one contract of gold for the risk side on gold when we calculated that, and we also had the two contracts here when we did the volatility calculation. So I would look at the two and say, I'm going to do one gold contract. It's going to keep it
Fantastic.
the most mentally capable of me dealing with it. And I don't have to worry about
these
it.
aren't that complicated to compute, right?
You learned the math in like 7th grade or something.
Right. And I think you might have even made a spreadsheet.
I did indeed. Do you want to go to that now?
Are there more slides here that you
Yes, there are.
want to get through? So let's get through those first.
There's one other thing that I wanted to touch on it quickly. It'll be the same calculation, so I'll go very quickly.
Yep.
But a lot of traders obsess over getting into a trade, and then the ongoing trade sort of gets ignored. It's sort of like fate is going to tell you whether you did a profit or loss on this thing, and you're just going to kind of watch it and do nothing. But in my opinion, your job does not stop. You got to still say, my famous silver trade that Jack covered in my chapter on Market Wizards, my new Market Wizards, the book. I talked about that silver trade. That's a very impactful to me and very famous silver trade now, thanks to Jack talking about it, where I go into the trade and I've got a multiple contract position and I'm a trend follower, and darn it, I'm going to hold on until we get our stop loss. And the Hunts happen to be trying to corner the silver market at the same time. So we're getting limit moves up, and I'm taking a $130,000 futures portfolio. And at the top, it got to about $500,000. And this is all within 6 weeks or 8 weeks or some stupid. You better believe that got into my head. I was not
into
Mr.
your stomach
Serenity.
too, probably.
I'm calling my broker about every other hour and bugging him on what's silver doing, because back in those days you don't have computers and PCs and trading. This is back when they moved paper into the pits, and you had to talk to your broker. So I'm that old, and I tell you what, boy, it taught me a lesson about why it's okay to stay with a trade. You've caught your perfect setup. You've gotten in perfectly. You've got the perfectly sized position. Everything's great. Now, conditions change. The market starts going. Everybody starts jumping on. The news starts coming out. Maybe some additional fuel gets added to the fire and it's going nuts. There's no reason why you should have to hang on to that same position you put on initially when conditions have totally changed at this point. So I manage my ongoing positions, and I do the same procedure. So I don't, let's not obsess over it, but basically if say the equity is 105,000 and now I allow a 1.5 in an existing position. So your
initial risk was a 1%, but when a position goes in your favor, you'll allow it to grow to up to 1.5%. of your portfolio before scaling it
You
back.
could think of it as playing with your profits a little bit, you
Yeah,
know, because
sure.
you're
Yeah.
no longer you're probably now the odds of taking a loss are diminishing. You're willing to
Right.
take a little bit more risk at this point and not
Yeah.
have it affect you.
Yeah.
I would submit to you that you would not want to put that number at, say, 10% or 20%, because you
Sure.
basically are saying that from your equity high, you're willing to give all of that profit back and have it all wiped out. And most people, that psychologically is not a good thing to do.
Yeah.
So
So is your number 1.5%? Is that what you use?
it varies with each.
1.5,
My
2
personal
maybe?
number, my personal number varies whether I'm managing ETF side of my strategies or future side, or whether I'm doing a 9-day index strategy. I have 8 strategies I run, so they're all over the place. It depends on what I'm trying to achieve.
Yep.
But bottom line, the same calculation comes out in 393 shares over here in when you look at managing the ongoing risk. And by a similar token, if we do futures and 105,000 and 1.5, and then we look at the new risk levels and work it all out, we're down to 1 contract, which is what we started with, and gold.
So are you looking at every position every day?
Yeah.
And making adjustments as needed to make sure that it stays within your tolerances?
Exactly.
I think one of the things that was one of my big ahas in my career is realizing that it's hard to endure big profits psychologically, right? Everybody thinks about it's hard to endure big losses, and it's true, but it's really hard. Like if you get, especially if you get a big gain, like early on in your position, you know, you start to think about losing that gain, and it messes with your mind in the same way that losses mess with your mind.
Yeah, you agreed. You want to lock in the profit and go celebrate that night.
Yeah, right. Well, I explained it with a reference to a couple of Nobel Prizes in economics from Daniel Kahneman and then Richard Thaler. But the idea is that we hate to lose, right?
Right.
And when we're losing, when we're underwater, the fact that we hate to lose makes us not want to sell, because selling equals loss, right?
Right.
But when we're winning, the fact that we hate to lose attaches itself to our profits, and we become fearful of losing our profits. So we're risk seeking when we're underwater, right? We don't want to sell. We want to take more risk, double down, et cetera. But we're risk averse when we're winning, because we don't want to lose the profits that we already have. Right?
And on the positive side, you're greedy and you want to lock in the profit.
Yeah.
It's
exactly.
both ways. I mean, it's the mind can play a lot of tricks on you. You have to be aware of what's going on.
As you said, the most important thing is the mind.
Yeah. The
right?
volatility here, the same exact calculation, not managing the volatility can allow a position that goes crazy, like my silver position in the favorite example I used way back in New Market Wizards Day. That dominated my portfolio. I had like 10 things in my portfolio. No, I had silver and a couple other nuisances. Silver was going up and down like $30,000 a day on what started out as a $130,000 portfolio. So believe me, I was just trading silver, and then these other things were sort of a nuisance. So I try to keep all the positions contributing somewhat equally. And that's the volatility side of things. So in the example, again, same calculation, I changed the numbers slightly. I moved up to 1% that I'm allowing for volatility, because I'm thinking, all right, well, the position's gotten exciting. It's very profitable. I'll give it a little more room mentally because I've built up a nice profit. So I'm willing to let it swing the portfolio a little bit, but not, again, 10%.
Yep.
And when we work out that calculation by the same formula, it's 583 shares. And then when we go to gold, it comes out 1 contract. And when we put them all together, we look for peel-off trades. So what I would point out here is it is possible, and it has happened to me in my past, where something gets so volatile or so risky to my stop loss that I literally can't afford with the equity in my account, even one contract.
Mhm.
So the answer can get to zero, and you might be
Right.
better off psychologically just taking a pause on that
Mhm.
market and not getting involved.
Right.
It's telling
Sure.
you it's very, very dangerous, and it's probably going to be impacting your mental side.
Now, as you
So
pointed out also earlier, there are micro contracts these days in a lot of futures.
correct.
So
And that's
you get
why I use
balances.
them, because you get
Yeah.
some, like gold can easily be in that problem where you
Yeah.
get a big precious
Right.
metals move, and silver's going nuts and platinum's going nuts and palladium's going nuts. And you look at your gold and it tells you to do like one contract for a fairly substantial portfolio. And I'm thinking, well, maybe I can do 5 or something, or 4 if I do the micro contracts. And that
Mhm.
allows me on my ongoing position controls
Yeah.
to peel off. So let's say
Yeah.
my ongoing, well, let's show the example here and I'll show you a peel off trade.
Okay, great.
I finished it. Okay. A peel off trade would be something like, we go back to the 583 shares. And we look before it, we have the 393 shares. Now, remember, we started with 689 shares of this position, XYZ stock.
Mhm. Right.
Well, if it's saying now that I only should have on an ongoing basis 393, what would you do?
Sell off.
689 minus 393,
Yeah.
peel off and sell those many
394.
shares.
Yeah.
Now you own 393. You have a 1.5% allocation to your risk. You have less than 1% on your volatility side. Life is good. Your mental processes are functioning within the Bollinger Bands. Everything's
Beautiful.
good.
Love it.
You know, and that way you're kind of cruising along to Mr. Serenity.
Beautiful. So
Let's
can
take a
we
look
share
at,
that spreadsheet now?
yeah, let's look at the spreadsheet. So if we do this, let's do a new share. All I did here, and it's something, this is an example of a simple tool that I even do as a trader with my size of portfolio and with my more automation that I've done over my lifetime. Sometimes spreadsheets are pretty simple ways of doing things. And I just did an example to show how simple it is. I took a bunch of data on the SPY ETF from Yahoo Finance. It's free. Just
Open high, low,
export it,
close.
import it right into your spreadsheet.
Yep.
I do a quick calculation right here of what I would call a Donchian channel. It turns out in this case, it was a 9-day Donchian channel looking back. Highest high and the lowest low right here on these 2 columns, if you can see my cursor.
Okay. So you're just calculating the highest high and the lowest low over the past 9
Right.
days.
So in this
And
particular,
the spreadsheet's doing it automatically, which,
yeah,
that's not the main point of this spreadsheet.
no.
That's just a trend following system.
Yep.
The main point here is how we're going to position size using this
Correct.
simple trend following system.
So when we look at starting this thing, I'm starting with $100,000 again, and I'm starting with a VAMI of 1,000 to keep it a nice round number.
VAMI? What is
VAMI? Is a value of 1,000 invested.
Value of 1,000 invested.
The M stands for 1,000, I guess. That's a
Okay.
term from futures trading industry a long time ago.
Is that 1% of your position, essentially, of your $100,000, or?
No, sorry.
that's
My
just
equity in this
okay.
case, I'm just going to trade one thing in my portfolio to make
Okay.
So
So
it
a
simple.
VAMI is some industry term, meaning just value of $1,000 invested.
Yeah, it's just an
Okay.
index.
I never
Starts
heard
at
of it,
1,000.
actually.
You can start it at 100 if you want.
Okay.
Got
Got
So
it.
the risk per share, if I get into looking at the dollars, is $4. The true range is $4.38
Okay.
on that first day. So when I look at the existing volatility and I look at putting on any new trades, and I calculate it by my risk number, which up above here is initial risk is 2% up here where my settings are, 2% to get in,
Okay.
1% initial volatility, I decided.
Mm-hmm.
You can make them anything you want. In fact, if you have the spreadsheet, I could change those numbers every run and do it any way I want.
Mm-hmm.
See the effect. when I take the calculation though, and I look at risk, I can do 457. When I do volatility, I can do 229 shares. I take the smaller of the two, 229, and the very next day I get a short signal because it goes through my 143 low, 43.88. I'm in at the open at 143.53, and it closes the day down to 139.75. So I have a profitable day. How many shares do I now own short? Well, 229. That's what we calculated over here.
Okay.
The 229 is at 143, which was the open.
Yep.
Daily profits came in at $864.28. So my total equity went up by the $864. My VAMI index moves, and we start the process all over again for the next day.
Okay.
The next day, the new positions are showing that we only need 234 shares for risk and 174. So for volatility, which makes it 174, and the process just keeps going and going.
So now you're going to
As
peel
you can
off
see,
50 shares, 55 shares. Right?
no, that's the number of new shares.
Oh, number of new shares.
The number of existing shares, meanwhile, over here on the existing columns, starts going down, and it says you can hold on to 261, 275, 295, 261, because conditions are changing. You're getting closer or farther away from your stop losses. You're getting increased or decreased volatility. So this number is a constantly moving target. We started with a 290 or 229. And as you can see from what happened in this case, we went all the way to the next buy signal. We never had to adjust our position.
I'm just a little confused, like what would cause you to add new shares to a position?
I wouldn't. That's why it says 0.
Okay. So
I never add to an existing position because the return to risk ratio of a trade, if you think of it philosophically, every day that goes by, you're one day closer to getting out of your trade. So you're running out of time. Even if it's, the trade's going to be on for 2 years, you're still one day closer to getting out. And so the return to risk that I calculated over time on trades on average diminishes over the lifetime of the trade because you're getting closer to where you're going to get out. There's just not that much return left. So for whatever risk is still there, as the return diminishes to 0, as you get close to, or maybe even negative, as you get really, really close to your stop loss point and the trade is maturing, your return to risk is really terrible for late in a trade. So I don't ever buy extra positions late in a trade. Let me see, is there? So
let me just ask you, how can folks get a copy of this spreadsheet?
I've incorporated it into the trading tools for Excel, which I think goes for $120 over on enjoytheride.world.
Okay.
If you want to go there, you'll get not only this spreadsheet, but a whole bunch of other spreadsheets, worksheets that cover things like various buy-sell indicators, position sizing algorithms, like little attempts at trying to show you how you can put together a trading strategy, just like I've done here with this spreadsheet, where you have a very simplistic trading engine to buy and sell, and you have a position sizing algorithm to not only manage your new positions, but managing your existing positions. And you could have, if you traded 10 or 20 futures markets, you could have a worksheet for every market and just add the prices for today and copy and paste the formulas. And
if you're a serious trader, you can probably recreate this spreadsheet yourself.
Yeah, exactly.
It'll probably take you more time than it.
Yeah,
it'd be worth
took me
pay $120 to get it and a bunch of other spreadsheets.
I think it took me a total of maybe 4 total hours to do this or something, and to get all the bugs worked out of it and get the data over and save it. And
one other thing that I just would like folks to know about is your PDF book. Let's show this chart.
I'll just show this, and this is the reason I do what I do. The gray line is taking 60% of your $100,000 and putting it in the SPY and having 40% just sitting there doing nothing.
Okay.
And as you can see, buy and hold, if anybody needs to really see the type of risk and the mental anguish you go through in periods like this and like this over here in COVID,
Yeah.
you know, it's really hard to stay on that path. You know, with all due respect to the buy and hold crowd that preach that over and over again,
Yeah.
I personally am not going to be sitting there watching my portfolio go down 35% and do nothing. I'm going to abandon my strategy because that's way too much anguish for Mr. Serenity to take. On the other hand, if we look at the two different approaches as a percent of equity, just take and go ahead and use position sizing with the blue line and use just a percent of equity and just go ahead and throw in X percent of the equity. In this case, I used 60% of the equity. The thing I want to point out is, look, both lines started at the same spot. Both lines ended up at roughly the same spot. Which ride would you rather be on? The blue line, the orange line goes lower here. Then it gets above the blue line where I have my cursor now. It gets below again through all of this period. It gets above over here and then ends up at the same exact place.
So the blue
If
line
I could get to the same place by a smooth line or a volatile line, which one would you prefer?
Smooth line.
I'll let you answer that.
Give me smooth.
All right. So that's the lesson to be learned with position sizing. You do a little extra work, but what you do is you smooth out your curves.
Yep.
And I think that's in my mind, what I'm trying to get to more.
Yeah.
Could you make more money? Hey, let me just show what happens. Let's make this 100%. 1,000. Let's not do 1,000. Margin will be tough. Okay, look what happened.
So you're just levering up.
Yeah, you're levering up, you're getting a wilder ride, you're making more money. And do you really want to do that? It's your choice. You're the trader, it's your money, you get to decide.
Right. And that could have gone the other way too, right?
Well, it did right down here. Look at this orange line goes off the page down here.
Off the page, right?
Right. That was a trying time. That was the 2000 bubble crash.
I mean, it looks like most of the separation there came in 2002. Right?
2002. Then you got
that's where the orange line really separated, right? There too.
This right here is a whole lot more money than that little tiny guy right there.
Yep. Yeah. A lot more volatility. And yeah, that's what people need to learn to factor in. You know, how much up and down movement can you take? Because what ends up happening is that when, you know, those ups and downs get out of our kind of psychological Bollinger Bands, we end up making rash decisions, right? Absolutely. And throwing in the towel at exactly the wrong time and then not getting back in because now we're gun shy.
Perfect.
So that's just the reality of being in markets. And that's why ultimately the mind is the most important thing to factor for, right? Your mind. And such a big part of that comes from position sizing to make sure that you're kind of staying within your bands of what you can tolerate.
And the simple advice is, if you want to start out and you're not sure and you want to be conservative, make the numbers smaller. Yep. Don't put as high of a percent. Don't do 1%. At this stage in one of my long-term futures programs, I'm at 0.5% risk for a single contract in my futures, my own futures. And I've got 45 years of trading experience, a fairly large size portfolio, as you might guess, but you know, I'm trying to keep things stable. I don't want to go back and manage money again. I'm having too much fun in retirement. So,
so I just want to show everybody something real quick.
Yeah.
Your book here. Let's get back to the top. Successful traders size their positions, why and how.
Yep.
Hopefully everybody can see that. This is a $10 PDF that is available. Let me show everybody how to get it now. Just got to change my
Enjoy the
share.
ride.world.
All right.
Or Amazon. I think it's on
Share.
iBooks over at Apple.
Yeah, but you get the, you probably get more of the royalties if you buy it from enjoytheride.com, right?
Slightly.
Okay.
It's not
So
going
if
to
you go
change
to
my
the
life.
Learn
Not going to
store,
change my life any which way.
and here's the book, and you can purchase it
Along with all sorts of other stuff.
right here
Yeah.
for $10 on Tom's
Yeah.
website. And are the Excel sheets on here too?
Yeah, right over here.
ETR trading
ETR
package
trading tools for Excel.
for Excel. All right. Well, Tom, that's fantastic. So simple, right? I mean, I've got Van Tharp's magnum opus on my shelf over here, you know, and it's hard to get through.
I found it hard to get through. I enjoyed my chapter. He talked about the Basso position sizing technique in one of the chapters.
Yeah.
And it's been a long time since I read it. And I gave him full permission to put that in there.
Mm-hmm.
And some of the other ones that are interesting are things like, what was it, Kelly and Optimal F, where you get into sizing your position so large that you make the most amount of money you possibly could in history.
Yeah.
But if any of your drawdowns get a little bit more than history, you are out of the game.
Yeah.
That is not the way to position.
The most important thing, though, is to do some kind of position sizing. And I love how simple you've made it, Tom.
Yeah.
And I just want everybody in the foundation and everybody who's doing trading to know that this, as you said before, this is like free money. You know, this is free money and free serenity.
Yeah.
And I think it's priceless.
Yeah.
So, well, one other thing I did want to ask you about, because I was reading in your book, you were talking about when you set your stop losses, you don't usually use like a fixed percentage stop loss or kind of a mechanical stop loss. You usually set your stop losses in response to what's going on in the markets, right? And essentially, you know, where's the number that you think you might have to endure in order for your thesis to play out?
Right. You know, a simple example would be, let's say, I don't know, crude oil, we'll just make up some story here.
Great.
Let's say crude oil's bounced 5 times off of $60 a barrel.
Mm-hmm.
And then all of a sudden starts breaking up to the upside. Well, I might set my stop at $59 a barrel, something below where it's sort of found its bottom before.
Mm-hmm.
You know, that would be, then if you're breaking out at 70 and your stop's at 59, you got $11 a barrel in risk there. Then the next question is how many should I do? So depending on the size of the account, if you're trading $1 million account, it's going to be a different answer than 100,000 and a different answer from a $5 million account.
Right. But the first thing is to decide where your stop is.
Yeah, I don't set the stop by how much I'm willing to risk, because a lot of times when you do that, especially in small portfolios, you're going to be setting your stop way too close to where the market's trading, and you're just basically going to be in the noise. The noise of the market will take you out pretty quickly for a loss. And so I try to set a logical stop, assuming one share or one contract.
Mm-hmm.
And then I answer the question of how many contracts or how many shares should I buy?
Because you've got risk per contract or volatility per contract, and then that tells you,
exactly,
your total risk per position divided by your risk per contract tells you how many contracts you can buy.
So I start with the market and let it talk to me first.
Yeah.
And then I say, okay, now it's told me what the risk situation is and the volatility of that market. Now I am going to, as a trader, manage my risk and volatility by putting this much of my position into that one instrument.
Well, Tom, I know I think we've covered our objective of position sizing. I can't resist, though, just to ask you for your perspective on markets today, given your experience and still active in markets. What's going on in our world of markets here
world
on
of markets right
March
now?
31st.
World of markets right now. There's a lot of one of the obvious themes that I see in my trading so many different futures. I probably have now 55 to 60 positions across 8 strategies. And so sector ETFs and futures and all sorts of stuff I'm doing.
Mhm.
One of the things that's
And
happening
you're
right now,
retired. You do this kind of.
well, but it takes me about 20 to 25 minutes a day.
Wow.
No big
Okay.
deal.
Computers.
The rest of the day I do interviews or I go play golf or whatever
Right.
else. I don't
Write
even
books.
have my trading screen up right now. I wanted to have the bandwidth for you. One of the themes that's clear is that in things like everything from cotton to lumber to copper, just a bunch of different things, precious metals to some extent, you're seeing inflation. That's economically speaking, that seems to be a given. All the numbers that are published are also coming out fairly high, like 40-year high inflation numbers.
Yeah.
The second theme that comes out of that is my short positions in bonds. I've been short for a while. It's clear the Fed Reserve is trying to raise interest rates. It's clear interest rates are going up. Debt instruments are falling. The 60-40 bond portfolio is going to have rough sledding and going down the road, I think, because I think it's possible that both stocks and bonds could be going down at the same time, and that will not be fun for a lot of people. The next theme is the stock market went through a fairly significant correction with the major indexes or the big guys more in the S&P and so on hitting correction territory over 10%. And the NASDAQ actually reaching 20% plus,
Yep.
Which would be a bear market. What's happened now is it's flipped. And in the last couple of weeks, I've taken hedges off. I've gone from 20% invested on my sector funds to I think I'm 80% now, something like that. Just in a couple of weeks, it has been dramatic up.
Yeah.
So that seems to be going that way. I don't know if I would want to trust this rally, but I do my strategy and I'm a disciplined trader. So I went ahead and got into all those positions and I have my
Try not to
stop
question
losses
it
set
too
and
much.
everything. But it seems to me we've got a lot of tough winds coming at us from different directions going forward, economically speaking. So it wouldn't surprise me if real estate, given the higher interest rates, the inflation of things like lumber that go into real estate and building houses and all that, it wouldn't surprise me at all if you see in the next 18 months some real estate softness, prices going down instead of up. In places like Phoenix, where it's insane and it's completely a bubble, I wouldn't be surprised to see 20, 30% down in some real estate prices within the next 18 to 24 months. And then I think, then who knows what happens from there? Do we continue into some kind of a bizarre depression of some sort again, like the 29s? Or do we somehow go into a hyperinflation where everybody's trying to scramble and just live with that? It's really hard for me to predict
Stagflation
that
of the
part.
70s.
Yeah, this is acting a lot in some aspects like the 70s, but in some ways it's so much worse.
Yeah.
And it seems to me unwinding it might be a whole lot trickier. I fail to see how the Fed's going to do a soft landing on this one. This might be a rough, this might be landing without the parachute.
Yeah, I think
it might be tough. So
I
in
feel the
terms of
same
my
way,
trading,
and
I
it's
just
not.
keep running it. I keep running it every day and doing what I do. And my economic predictions are fun and games for my brain, but it doesn't affect my trading whatsoever.
Yeah,
So,
I noticed like even on that little system that you showed, you avoided most of the COVID crash.
actually, the COVID crash was amazingly profitable for me. And I had in 2020, 103% return in my portfolio for the year. And I trade conservatively. It's not that I was smart. It is not that I knew the world was going to do that or anything. I didn't predict a darn thing and I didn't change my strategies or anything. The reason I made so much is I caught the entire downswing. And then when everybody was sitting around, twiddling their thumbs, talking about double bottom tests and we got to go down and test the lows before we make a significant move, the market just went straight back up. I got my indicators to go over. I went in, I sized my positions. They were a lot smaller because the volatility then was humongous.
Mhm.
And so I had smaller positions, but I caught the whole up run.
Wow.
So I made it coming down. I made it going up. It added up to a lot of percent, probably the best percent of my life. But it wasn't that I was any smarter than I was the year before or the year after. It was just the markets moved so much that year. It was unbelievable.
And you weren't second guessing yourself
No,
all the way
if
down
there's
and all
one
the way
thing
back
that,
up, because it was a
yeah,
crazy time. I mean, you're trying to make sense of it in your head. No, what?
oh,
The economy is
well,
shutting down and the markets are soaring. Come on.
I heard
No way.
stories of a lot of commodity trading advisors that looked at the insanity and said,
Yeah.
I have never seen volatility and news coming together like this. I am just going to go to cash for
Yeah.
a while
Go
and
to the
then
beach.
start it up again. And they missed out on
Mm,
so much money.
yeah.
And kind of sad that they
Beautiful.
did that. But that again is the mental side creeping in and making
There
people
is.
uncomfortable. And markets have a way of doing that.
They sure do. They sure do. Fantastic, Tom. This has been exceptional, as I knew it would. Really appreciate your time. Encourage everybody to check out your resources at enjoytheride.world. And thank you so much.
Hey, it was fun, Richard. Let's do it again.
All right. Thanks.
Bye bye.
Bye.